So, in order to understand how inflation works, one must understand how credit creation works. Now, people usually prefer to pay using a credit card as opposed to using hard cash. Now, there's two reasons for it. The first reason is you can actually pay it off over a period of time. So, you can buy what you need to buy today and you can pay it off, or you can have the money distributed evenly across a period of time. So, say 10 years. The second reason people prefer credit card is because you might not have the cash right now for a substantial purchase. So, for example, you were going to go out and buy a house or a car. You might not have the money to buy that in your account right now, but you might have a need to do so. So, what you can do is you can buy the car on credit and then you can pay out the money in installments for the duration of that loan. So, banks usually facilitate this credit creation, right? Uh, but what happens when banks actually go ahead and do this and lend to borrowers is they actually end up increasing the money supply in a given economy, because you're basically you're creating credit, money that's unaccounted for, which is then going to be paid in the future. So by doing that, you actually increase the money supply in any given economy at a point in time. So that's extra cash or advanced cash. That's usually not in a physical, quantifiable uh, sort of position. Now, when the bank actually lends to its borrowers, as mentioned, the banks create money that's not really there. But what they also do is this money is then advanced to uh, various industries or consumers or government. So when it gives the money to to the borrowers, it creates money surplus, which is then distributed amongst say governments or industries or consumers. Now, the money that's actually in circulation is actually further circulated amongst these three, right? So, governments, right? So, what you have is this money is then spent circulating within this economy or within this circle. So, money circulates within these three entities. Now, the money that's usually circulated between this economy is primarily spent on goods and services. Uh, and again, this is done by people who've actually borrowed from the bank, so it's done on credit. The people to whom the money is paid to, so say like businesses that actually provide you with goods and services, they then deposit that make believe money or the makeshift money into their own bank accounts, which then further allows the banks to create fresh credit all over again. So they kind of just repeat that cycle, right? Now, it's generally estimated that the credit creation process accounts for close to 96% of the money in circulation in pretty much every developed country there is. So 96% of the economy runs on this credit. The remaining 4% is what gets accounted for in cash or your coins and so on and so forth, your hard cash. So 4% is your coins and notes. Now, the problem really comes if this entire process becomes uncontrolled. So let's presume that this goes out of control. What happens next is it would lead to an extreme spike or a rapid increase in the money supply at any given time. So increase in money supply. And there's too much money that's running around and fewer goods to buy, so the price of the goods increase, which then increases the inflation. Now, this is kind of why entities like the BOE or central banks, they kind of exist to be able to combat or to be able to curb this inflation. The central bank kind of exists to combat said inflation problem, which is the rapid rise in the cost of goods and services.